Welcome back to the Investor's Guide to Thriving for June 25th, 2020. We'll be hosting monthly virtual events on the last Thursday of each month this summer, so tonight's event is going to be followed by a date on July 30th and again on August 27th. Since our last webinar, a lot's changed around the world. Coronavirus is still here, and the outlook is still very much uncertain, unless you're Dave Portnoy, in which case you know for certain that stocks only go up. Indeed, there's no shortage of financial chatter right now. Larry has recently launched his official YouTube channel. You can find that easily by searching Larry Berman Official on YouTube. There you'll find past webinars and our new weekly market video update series featuring quick 2 to 3 minute summaries of what's moving markets in an easy to consume format. Make sure to hit the subscribe button and the alert button so you'll know when Larry posts something to the channel. Our friends at BMO ETFs and the TMX continue to host a weekly market insights webinar, which you can opt into via the post-event feedback survey. Of course, you can always catch Larry on BNN. Berman's call is still at 4:30 p.m. Eastern on Fridays until COVID goes away and Justin Trudeau stops making Monday television appearances. And if you want to get all of these highlights delivered directly to your inbox for your maximum convenience, you can also sign up for our newsletter or visit bermanscall.com. Now, if all that sounds like too much information, we can do the hard work for you so you can have more time to enjoy your day and still sleep at night. We've partnered with BMO to offer ETFs and funds of ETFs managed by Larry and available to you through your online brokerage or investment advisor. If you don't have an investment advisor, but have a portfolio of $1 million and up, our ETF Capital Management private wealth team would be pleased to offer you a wealth management proposal. As you'd imagine, this way of working together allows us to make the fullest use of our wealth management and investment toolkits. You can learn more or request a proposal online at etfcm.com. Now, if you just want to watch a replay of tonight's webinar, all you need to do is complete our event survey. Tomorrow morning, you'll get an email containing the survey. Tell us how we did, and you'll get a link to access all of the above and submit questions for next month's webinar. As usual, Investor's Guide to Thriving comes to you at no cost in favor of two causes that Larry and I believe in passionately: sick kids and the Baycrest Foundations. We hope you can join Larry and I in supporting childhood leukemia research at Sick Kids. We also appreciate your support for the groundbreaking work being done at the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you very much. We noticed that we've got a lot of support throughout these webinar series. We don't know if it's having so many people online or just the coming together as a community and getting through difficult times and supporting those in need and research that's in need. For those of you who would like to make a donation, please use the links in the survey you receive after the event. It lets Larry and I know which donations to match, and we do match all of your donations at the end of the year. Thanks also to our sponsors, National Bank Direct Brokerage, who will also be bringing you Larry's first set of Investor 101 videos on YouTube, and of course, BMO ETFs. BMO ETFs has been our top tier partner in investment education since they first started in 2009. Their efforts to inform investors are top tier, and so are their friendly and knowledgeable ETF specialists. So with that in mind, I'm happy to introduce, all the way from Calgary, Alberta, Mr. Top Tier himself, Rob Butler from BMO ETFs.
Awesome. Thanks, Jared, for the introduction and for including us today on the weekly and monthly presentations. We love having an opportunity to talk to all of our clients and supporters and do the educational pieces around ETFs as well. As far as what we're going to cover today, one thing that continues to be topical is factors. So for those of you that are familiar with factors, and maybe you've seen one of these presentations before, I'm going to revisit one in particular. Having said that, for those of you that are not familiar with what a factor is, it's effectively a strategy that takes the traditional index that we're all familiar with, whether that be the S&P 500, the TSX, maybe an EFI index tracking international markets, but then it has a very definitive screening process that we would apply to it. So you'll see in the slide in front of you there, we've got a couple different topics and themes in the factor category that we really do identify with, and I believe that our client base and supporters, they do think of these types of strategies when they think of BMO ETFs, and some of the ones that we're best known for in the smart beta or the factor space would be low volatility of which we've had a number of different strategies in that category running for almost 10 years now in some cases. So great track records behind them and incredibly popular in most market cycles, and especially in the last couple of months, we've seen added demand to that type of theme. Also dividend screens, so those of you that invest on your own, and the bulk of today's audience would be just that, would be looking at dividends in the Canadian market, potentially US, international. They have cash flow needs, and in the case of Canada, they like that tax efficient dividend that comes off of that type of portfolio. Quality. Now, quality is the one I'm going to spend time on today, and to give you some context, we're going to be spending about 10 minutes on this. So I'm going to narrow in on the quality screen and what that looks like for us and what we're attempting to do there. And then for those of you that have not spent time with BMO before, we do offer fixed income right on the equity side. So kind of like what we're going to talk about today with an enhanced dividend type of approach to investing. And then the effective broad market, again, back to those indices where it's really low cost and transparency that clients are trying to achieve. In the case of high quality, the way MSCI defines it is based on three fundamental accounting ratios, and that is return on equity, year-over-year earnings growth, and then really well-financed or low-leveraged companies. Now, the beauty of using an ETF as it applies to any one factor, and in this specific case, quality, our team's effectively agnostic in terms of what that exposure looks like. All that really matters to us is that the names within the basket, of which in the case of the US, there's 100 names, and in the case of international and European markets, you would also find 100 names within them as well. Now, granted, when you look outside of the US market, you're going to be able to pick up names that are also listed in different countries. But what I love about this concept is we're agnostic in terms of the particular names that we're buying, as long as they adhere to that screening process, being the return on equity, year-over-year earnings growth, and low leverage. So the screen in front of you, it does highlight, as far as the tickers are concerned, the difference between ZUQ being the US market, ZEQ, which is the European market, and then GQ, which is the global quality ETF. So the idea there, and the name really says it all, it's depending on the geography that you want to get exposure to, you make that decision first, but then as a result of that, we would apply the exact same screen, or we can call it overlay, to the basket of portfolio, where we could be choosing any of the securities that would trade within the index, but then it becomes far more targeted based on that screening process. And you can see some of the content captured here as far as the names that you're going to be getting exposure to. Interestingly, you look at this basket and you could put this up really against any other factor that we have available on our shelf. Not only did it outperform when the markets were coming under pressure, but in this recovery, because it preserved partial capital on the way down or the drawdown, it hasn't had to recoup as much on the recovery that we've seen in the last 2.5 months. Now, regardless of what your outlook is on the market, as a core position that's well diversified based on, again, no particular outlook on a sector, no particular outlook on geography, again, it really comes back to those fundamental screens that we're using. And what we really find is that so many of our advisor base that use ETFs in the portfolios that they construct, many of them are or define themselves as quality managers. And so much so that they find that if you looked at the top 10 names within, and you can see the slide here, in the case of the US quality ETF, it would be very rare that you wouldn't hold, if you're buying individual securities, at least 50% of these names for the same reasons that we've seen the likes of Apple, Visa, Microsoft. I mean, these are all high quality names, really well financed businesses. Not only did, some people might think they're recession proof, but they've really shown that with COVID in place and so many of us having to work from home, these are the names that have obviously benefited from the pressure that we've come under. So in terms of timing, I'm not pretending that I have a crystal ball and I would suggest when to move in or out of any of these products. I would say though, longer time horizons, 5-year, 10-year, 15 years, to know that you're buying the best and the highest quality names based on those sound fundamental principles. this is not something that you need to trade around. I mean, I love the concept of an RESP or even an RRSP, using this as a core position, allowing the ETF provider to weight the portfolio on your behalf. It's very well priced, so incredibly competitive. To think that you could buy that type of strategy for a little over 34 basis points, so not even half of a percent to get access to that particular ETF if you're buying it on your online platform. You'll also see the sector allocation. So I keep using the word unbiased or agnostic, but we really are. The fact that IT and healthcare are leading the charge, that's not because we like those two sectors more than any other. It's because that's where the highest quality names are coming from at the moment. And we do rebalance that portfolio every 6 months because the environment and the landscape is constantly changing. So we stick to that regimen where in June and December, we're going to rotate that basket based on the 100 securities that are held within it to determine what the overall weighting is going to look like between those different sectors, between the different securities that you're getting access to. And it's a really well diversified way to play the equity market without overthinking anything. So that's my 8 or 9 minutes. If you have any questions around the quality suite, I mean, I know Larry does use that in a number of his portfolios when the timing is appropriate. I think for those of you that want to get more color around what the quality product line looks like from us, feel free to visit bmoetfs.ca and you'll find all of our materials there. You could also email me directly at rob.butler@bmo.com and I'd be happy to help you. Now, we're all here today to listen to Larry Berman. Now, Larry Berman being the co-founder of ETF Capital Management, he's incredibly visible on both BNN and now YouTube, which is exciting to embrace different mediums to get the message out there around education and ETF development. As far as the BNN show, I mean, that is the #1 watched segment on the news network. And I think Larry's held that title for at least the 5 years or 6 years that I've been working alongside him. So a great title to hold. As well, Larry does oversee 4 different mandates at BMO Global Asset Management. So for those of you that like everything you hear today from Larry, and you like the concept of using ETFs as a low-cost, transparent investment vehicle, that's very much what Larry does for our client base. He combines the oversight and the professional management skill set that he brings to the table, and he's able to access any ETF that trades in North America, whether it's BMO or a third party, as long as it's the right product and strategy for the client's money that he's managing. He's also very much technically and fundamentally focused in terms of determining what that portfolio is going to look like at any one time. And that's in the case of dividends, growth, and balanced funds, both in ETFs and active mutual funds. So with that introduction, I'm going to hand it over to Larry Berman, and thanks very much for taking part today and having me.
Thanks, Rob, and again, thanks to our sponsors. Excited to be back after a month of golfing. No, I'm just kidding. But I'm thrilled the global economies are opening up. Shutting down the world so rapidly as we did, maybe it was needed, maybe it wasn't, but what it did tell you is that the world and the governments that lead us were wholly unprepared for this, even though the scientists have been warning for years, and not unlike market timing. There's a hurricane or 2 or 3 going to come every year. You estimate, based on certain weather patterns, that there's probably going to be, 1, 2, 3, 4, 5 that might be devastating, but you never know when they're going to hit. You don't know the dates, you don't know the cities, and so forth. And it's not dissimilar with the global pandemic. You know the risk was there. You can't base your portfolio on tail risks that might happen once every 100 years or 50 years or 20 years or something like that, because you just can't. It'd be far too expensive from an insurance standpoint. So I want to talk today a little bit about the difference between the thought process behind what a day trader and how a day trader thinks versus investing for retirement. And they are very, very different mindsets. want to talk a little bit about what I think the biggest risk is facing us beyond COVID, and that is the US election and the high probability that we get a change in government leadership in the States. And then show you some charts and look at the differences between, a market V recovery and an economic W or a U. And then I'll get to as many prepared questions as people emailed in as I can, and hopefully there'll be time for me to get to some live ones. I've already answered a few of them that have come in already online. Okay, so let's fire away. Day trading versus being a portfolio manager. So I clipped a graphic here, and Jared in his opening remarks talked about Barstool, Sports Sky, Partnoy, and the millions of millennials, etc., that he's leading into oblivion, I think. But so there's a difference between day trading and momentum trading and investing for your retirement. And I think you have to make that distinction because the difference is in your mindset and it's in your emotional state. Picking a good ETF long term and a good strategy that like a quality factor, which is my by far, by magnitudes, my favorite factor. And while I tell people I'm a value investor, value as an investment style has been out of favor since 1998 on average. We've seen periods where value has outperformed, but the value factor tends to have a lot of financial institutions and it tends to have a lot of energy. And both those sectors, in my view of the world looking forward for 10 or 20 years, are well past their best before dates. And I can comment a little bit more on that as we go through here. So what I wanted to talk about is this bear market, this V, the mentality here, because the narrative in the marketplace, and I was reading somebody's comments the other day, and I can't remember who it was, and they said they did a Google search on "Don't Fight the Fed," and I have that reference here on the screen. It came up with 516 million results. So there's a lot of people looking online for what that means. Don't fight the Fed. It's a narrative that's been in place since Greenspan put the put under the market in 1998 after long-term capital blew up. That was the first time in the name of, we'll call it financial conditions, that the Fed came to the rescue. And ever since, don't worry about it. Markets will sell off aggressively. They always bounce back very quickly. The Fed will just be there forever. And I'm afraid, as much as they say the balance sheet is unlimited, that it's actually not. I heard after the market closed today, one of the ETF issuers had a conference call about a new ETF fund run by DoubleLine, Jeff Gunlock. And he was saying and suggesting that the Fed will probably have a problem if they ultimately go to this MMT model and literally monetize debt, like with no limits. And that we'll have that test at some point. It'll come quicker under a Democratic regime that goes more hard left, i.e. more AOC, more Bernie Sanders, more Elizabeth Warren influence in the policies, than a more centrist kind of view that would have been a more traditional Joe Biden kind of way of looking at things. But and when that comes, it's going to be meaningful. But in pretty much any path we head down, we're going to see at some point, once we get by the disinflationary impact of the economic shock we're going through, that we will have some inflation pressures. Now, a lot of these millennials that follow Partnoy that have got these bonus checks and now they're at home with nothing to do are working. They're buying what's working, and what's working in the new world is quality. We saw that in the outperformance in quality, and these are companies that have clean balance sheets, don't need to come to the trough, don't need to issue equity to pay off debt, aren't going to need support from the government, and are doing pretty well now, and probably have an uptick in business because they happen to be in the spaces that are benefiting from this new work from home economy. So the chart here printed as yesterday, it'd be different as of today's close slightly, these numbers, but year to date, the index I created there is a basket of Facebook, Amazon, Netflix, Microsoft, Google, the FANG M names. The other 494 companies are down 8.6% year to date. So the S&P 500's down 2. The 6 stocks are up almost 30, probably after today. And the equal weight version of the market is down around 10. We're still in a weak market, but a handful of stocks that are working are masking what's going on under the hood. And if I drill down and looked at the weaker companies, the ones that have been downgraded on bad debt, the ones that have had to issue in these terrible markets, the ones that may have had to come and dilute their shares to buy back some bonds, etc., are probably down closer to 20 or 25. And obviously the airlines and the hotel stocks more directly impacted by the lack of mobility in the world going forward for at least a little while longer, are down a lot more. So what's going on under the hood? We're still very much in a bear market. And if you're a day trader, this kind of matters, but not if you're trading the stuff that's working. And Partnoy's right in that sense, but to jump into a stock like Hertz that announces bankruptcy and having some fool say just go buy that, and a million people all of a sudden buy a couple hundred shares each or a couple thousand shares each and boost the stock, and all of a sudden you're making 50% an hour on your trading. I mean, that's obviously appealing to the gambling mentality. And more day traders and more active day traders tend to want the fast money and the quick fix. And I've been critical over the years about the name of the show on CNBC called Fast Money, and that's a very different momentum set mindset than how do I invest my retirement portfolio. And when it comes to how do I invest my retirement portfolio and how active you want to be, I've said throughout the last 3 months when we were doing these things weekly, I was showing charts of, the VCON, or VCNS, the ZCON, the ZBAL, the ZGRO, so the conservative, the balanced growth ETF strategies. And basically saying, when you're bullish, you could have up to 100% equities. I have no issue with that. But you want to do that when things are cheap, fundamentally. And that's kind of when we're closer to one of these terrible points, like how things were looking like in March and April for that matter. But in February, where fear of missing out and the markets kept going higher and higher and higher, that's where if you want to be active in your portfolio and you're running a retirement portfolio, that's when you want to be conservative. And I talked about the CNN Fear and Greed Index. And when that index shows you greed and extreme greed, that's when you want to be defensive. Now, for some people, that might mean having lots of cash. If you don't know what to do or are not capable of executing alternative type strategies, and we talked about a lot of them, including option positions, including alternative type ETFs that will go up when markets go down, bear ETF, for example, or an option strategy like writing a call to buy a put, which is called a caller. Those simple things make sense. But for the average investor, managing their retirement savings. You shouldn't worry about the next 2 or 3 weeks. You shouldn't worry about the next 2 or 3 months. You should be very thoughtful, longer term, looking out 6 months, 12 months, a year, 2 years, and saying, do I need any money now? Do I need any money to live off of? And if I do, okay, cash is appropriate because that's the most liquid thing. So let me put some money in a GIC for that. And the rest of it should be geared towards growing my portfolio in the long term. Now, all the problem exists in the marketplace, not because of bad analysts, because of the Fed, because of Portnoy or anything like that. It exists because individuals can't handle the emotional ride of the volatility in markets. Period, stop. And if you find yourself becoming emotionally influenced by the ups and downs, I got to tell you guys, you got to stop doing it on your own because you're going to blow yourself up. And you don't want to take your retirement future in your own hands and let the emotional ride dominate. So you only need to take moderate risk in your portfolio on average. You need to take higher risk, more growth, more equity exposure when things are cheap, and understand that you're never, ever, ever, ever going to pick the bottom within days and weeks. And if you do, you're going to get lucky. You have to recognize the environment of a market being cheap and oversold versus being expensive and stupidly valued, where when the corrections happen from those periods, they're going to be more violent. What leads to the correction at any point in time could be the Fed tightening policy. It could be something stupid on policy from a government. It could be anything unforeseen like a natural disaster or, God forbid, a global pandemic where the world shuts down, or a war or nuclear threat or anything like that that causes anxiety in the investment world. If you find yourself driven too much by emotion, you don't have the right portfolio. And folks, historically, it's always been fixed income and the bond market that provides us that balance and safety. And I've said for years now, in general, because of the low interest rate environment that we're in, that the bond market is broken. It doesn't provide the same safety that it once did when you can get a safe yield 4, 5, 6, 7% without taking undue risk. That 4, 5, 6, 7% today is high yield bonds, and it's a basket of the crappiest companies out there. And before this cycle is done, we're going to see a default rate of those companies somewhere between 10 and 15%. And guess what? The taxpayer now owns that risk because the clowns running the central bank, called the Federal Reserve, are now buying the crappiest bonds on the planet. This world, there's nothing bullish fundamentally about this. This is catastrophic in terms of what the central banks and governments have had to do because they weren't conservative. I'm furious with Donald Trump for cutting taxes 2 years ago because it wasn't needed. And anybody who tells you it was is an absolute economic moron. I can't say that enough because it was ill-timed. Because now when we need it, we're out of bullets. And now we have to literally print money and monetize debt to pay the bills that have come due. And that's not bullish. That's tragic. So there's a difference between being a day trader and trading the momentum of the markets and the swings up and down, and being fundamentally thoughtful about what you do in your portfolio and understanding that perfectly timing the ups and downs is never going to happen. And when it does, you get lucky. Okay, that is my underlying principle and view of the world. And one day, when I do finish my book, and I am working on it, it'll be very clear, and I will try to articulate as best I can. So let's talk a little bit about the retirees in the US election, because if you remember in 2015, when the polls were coming out, Hillary had been nominated, so we knew it was going to be Hillary over Bernie, and we knew Trump was nominated, and it was going to be Trump over the, 20 people who wanted the ticket. And all the polls said Trump couldn't win. And I made a bet with Paul Bagnall on air and said Trump's going to win. And why is he going to win? Because inequality is a big issue. The average person hasn't had a raise in 40 years. And Trump is a brilliant marketer. Everybody loves Make America Great Again, Drain the Swamp. Who doesn't like those two things? You don't have to be a Republican and a hard right person to understand that those are two brilliant marketing things. And Trump is a brilliant marketer. Now, after seeing him in action for 4 years now, we kind of get the sense that as a human being, he's full of shit. I don't know how to say it better than that. But the cohort that supported Trump by far the most were people over 65. And I simply don't understand why he doesn't want mail-in ballots. Because from a second wave perspective, and keep in mind what we're getting today is not a second wave of COVID. This is still wave one continuing, because it was always going to continue and keep going because the average person ain't wearing a mask. And we need to do those things to stop the spread. And when the leader of the free world says you don't need to wear one and tells you to drink bleach I'm just beside myself. But we know from the deaths that the people that have the biggest risks are the elderly and people with comorbidities. And one of the biggest ones is obesity. 30% of the US population is obese and 20% is morbidly obese and has diabetic issues and so forth. So when they get this virus and it attacks their system's not strong enough to fight it off. We're talking about 30% of the population, folks. And a huge percentage of them are over 65. I don't think Trump can win. So we'll see. People are now saying, oh, the polls don't matter. They were wrong last time. They'll be wrong this time. I don't think so. When you do the math, the episode I did in 2015 looked at the Electoral College, because that's how you become president. You get elected, more votes, even if it's one more vote than the other, except when there's dimpled chads, and then it's got to go to the Supreme Court for a recount. And you'll all remember Al Gore back in 2000 when that happened in Florida. The simple thing is Trump needed to carry Pennsylvania. There's 13 swing states. Pennsylvania carries the biggest vote next to Florida. And right now, Biden's winning, not only leaning towards like in Florida, but he's actually outright winning in a few of the states that Hillary lost. Remember, Wisconsin, Michigan, and Penn, less than 1% that Trump won those by. And the reason he went after Pennsylvania and coal mining and steel in terms of tariffs and policy was that he could swing the marginal voter that's been disenfranchised by the 40 years of jobs leaving and everything else. And I was listening to a CEO the other day doing a thoughtful interview on Bloomberg, and I think Bloomberg Radio out of the US does some phenomenal interviews. And he was basically saying, we sell our product, and I can't remember what industry what it was, but we go to the company that starts with a W and ends with a T. So he's talking about Walmart. And we go to them and say, we could produce our widget for $2.70. And Walmart says, okay, we like that, but you got to give it to us for 250. And at 250, the guy doesn't make a living. So what does he do? He says, okay, and he gets it manufactured somewhere else for 250, and that job leaves the US. So Trump saw that, recognized that, and he started this trade war because he wanted to bring the jobs back. So as supply chains get rethought and everything, we're going to have an inflation push. Absolutely. But the Americans, and the Canadians too for that matter, lesser degree, they don't want to pay $1 more for that product. They want it for $1 less. And it was the system. It was Americans that lost the jobs for Americans. And it was a bit of robotics and that kind of thing, that productivity. When Walmart says I want it for 250, the job either has to leave to go somewhere where there's cheaper labor, or they have to buy some technology so that they have higher productivity, so that their output per unit of labor is cheaper and they can produce it, so their profit margins are better. That's where all the jobs went. And the new jobs, and I was very excited to see what Doug Ford did here in the school agenda, and that they're going to start in primary school teaching kids about artificial intelligence and coding, starting in grade 3 or 4 or something like that. That's brilliant, because we're not graduating enough kids in Canada for the jobs of the future. And folks, the jobs of the future are not coal mining. They're not. Those jobs are never coming back. And Trump is an absolute moron, except it played very well in Pennsylvania. And I got to ask the question, the narrow 1% he won by, did he deliver? And if your answer is yes, you're naive. Okay, so I don't think Trump's going to win, and we're going to see a change of government. And that's the biggest risk, because the market right now is priced for perfection, not only on earnings, not only on a V recovery, but on Trump winning, and we're not going to a left agenda and so forth. And I think that as we get closer to the election, and some of the volatility that has creeped in the last couple weeks again, starting to get the feeling that markets are saying, how much higher can we push this thing with all these things, these question marks coming up. So that's kind of where I think we are, and we've got some of these big risks. So I clipped a couple of these from my buddy David Rosenberg's daily the other day, and David lets me put some of his research and give him attribution, and you can see there that these but what Rosie talked about was the economic pattern into some of these other big bear markets that weren't a V, that had these initial shocks, recovery rally, what we call hope rally, and then the economic fallout over the next year or so played into much more of a prolonged bear market. And there's 4 examples here. So the markets peaked ultimately in 1968, 69, we started getting the economic weakness. Markets are forward looking, start getting a bit of a sell-off. We got the high inflation risks starting to percolate. You've got the war going on in Vietnam that the U.S. was losing, and so forth. And you've got the Cold War heating up, and there are a lot of concerns there. And you get a weakness in the economy, you get a snapback, and some of those, period to period moves are inventory building and contraction. But we know today the consumer's 70% of the economy. And, so income matters the most in all the factors. 2 of the 4 main factors in GDP were already in recession. Industrial production and output were already in recession prior to COVID. And when people started losing their jobs to the tune of 20% of the US population, either furloughed or permanently laid off, or on a program where they're not working but getting paid through a temporary support, it's 30 million people out of a workforce of about 180 $460 million total. So not quite 20%, but high teens in terms of unemployment. And there's every bet that 5 to 10 million of those jobs are gone permanently, as small business can't make it through this, restaurants, retail, and all their support chains. So when we look at the economic rebound and snapback, what you have to understand is that you get these shocks, you get the recovery, but then you get the economic fallout. And it's happened in every major bear market in history. And if you think for a minute that the biggest economic shock to the world is going to be over in 2 months, you're absolutely playing against the odds. It doesn't mean it can't happen, but it's such a low probability bet that those making that bet today, to me, don't understand risk management very well. But for the last 2 months, Larry's an idiot because he's telling you not to invest and the markets keep grinding higher. But I think, like someone who manages your retirement portfolio, I'm not a day trader. I'm not trying to get the pick of the day and the fast money, even though there's a small element of what we do that's very tactical and short-term in nature. I'm far more strategic and thoughtful about the big picture and when to take risks. And folks, now is not the time. So study these, have a look at them, understand what they mean in terms of the context of the next couple of years, and understand that the economic fallout has room to go here. So let's have a look. The New York Federal Reserve just put out a research paper on what they think the economic forecast for GDP is going to be year on year, fourth quarter, in 3 scenarios. And the V scenario, the temporary lockdown scenario, explains the Q1 and Q2 shock. It's transitory. Demand comes right back, yields a relatively V-shaped recovery, with the overall hit to 2020 being 4%. Next year, 2.6, the following year, 0.8 and 1.3. So if you do the math of down 4 and then up 5 point something, you're basically break even by mid-2023. In terms of recovering the economic output that we had pre-COVID. So 3 years from where we are today, approximately, and that's in the best case scenario where we get a vaccine, it's produced very quickly, and everybody goes back to work starting next year. And the unemployment rate drops, as you can see it there, back to 3.4 by 2022. In the lockdown business cycle dynamics scenario, they allow for shocks to play a larger role, needing more persistent effects, meaning like we're seeing now, there's a second wave. It's moderate. They don't shut the whole economy down, but it does impact Disneyland, other places. The big meetings aren't allowed. Concerts don't come back. We're not playing professional sports with crowds. They're going to try to play them without crowds. They're shortened seasons. All those things that are just eating in, and restaurants are still at half capacity or 30% and so forth. And that's scenario 2. And in scenario 2, it's a 5.2% shock to GDP. And if you add up the next 3 years, and it's a multiplier effect, so 2.4 times 1.3 times 1.6. And if you do that math on a simple basis, the 5.3 is recovered fully by the end of 2023. But in scenario 3, where there is no vaccine, this thing persists, we get a significant second wave, change of government not expected, the economic policies then change and become less business friendly. There are no more share buybacks. They unwind the Trump tax cut. The Democrats take control of all 3 houses, the White House, the Senate, and and Congress for at least the next 2 years. There will be an infrastructure bill. I'll talk about that, but I don't think it comes until after the election because they're not going to agree on how to do it. In that scenario, a 10% hit to the economy this year, and I think we're going to be closer to that in actuality. And it takes 5 years for us to recover fully to where we were in terms of total economic output in the US prior to COVID. So it's 3 to 6 years to recovery. And the market today says earnings are going to go back to where we were expecting for next year. So the market's priced for scenario 1. And what is the probability that scenario 1 plays out? Ask yourself that question and balance that on a scale of fear of missing out and the day trade and trying to make money off the airline stocks and hotels and everything else that's moving rapidly in the Dave Portnoy world. And if you want to do that, go for it. But don't ever ask me if you should buy those things because I'm going to say it's not time to invest in them. You can day trade them if you want. Okay, when's it going to be time to invest in some of those stocks? When I say invest, I'm talking Warren Buffett, let's buy it. Let's not worry about it for 10 or 20 years because we've bought it well. There's lots of value and lots of prospect for outperformance and economic growth. And if you can answer that question, yes, then go buy it. And don't trade it and don't think about it. Know that it's a good investment for a long time. But I got to tell you, I think some of the airlines might go bankrupt. So we'll see how that all plays out. So as I've highlighted every week along now, and there's things I like. A lot of the things that I like in the technology space, I showed you how these performed, were fantastic. I told you not to buy them a few months ago. You could have. You would have been up 40, 50%. But it's not time to invest in them yet. I actually had a call today with a firm called Crane Shares. Crane Shares issues KWeb. And this is Chinese internet technology. It's up 60%, something like that, year to date. And I had a review with the portfolio managers, and I got feedback coming out of CICC, which is the big firm in China that they use for all their research and so forth. And they love it. And they're wildly bullish for every reason that they should be about cybersecurity, about internet, about online, about 1 billion people buying these products, about Chinese Silk Road and the initiative of distributing China to Asia and so forth. And they think they're 50% undervalued still. But for me, I think market risk is too high. But I love all these things, big picture. ArcW is an internet-based thing, cybersecurity, Internet of Things, robo, clean energy, software, emerging market, NASDAQ, genome technology. Like all these things to me are very, very exciting. And what I said to avoid in the shorts have been underperforming dramatically. If you look at the basket of names in there, save for the ones with good balance sheets. I've talked about ZPay a lot. There were some questions that came in, and I'll highlight that again. And emerging markets have started to take off. A lot of the things that I've liked have been working. And we own many of them, not all of them, in the BMO funds that we manage. But overall, I'm at my lowest risk level in all my portfolios. And I will be there until we correct again, whenever that is. I do want to talk about technology and infrastructure, because when it comes to those, what we buy and when we buy them are pretty clear. So, here's the cybersecurity ETF, the next generation internet, that ARC one that's up 60% this year, something like that. The Internet of Things, robo. So the basket of these fell from mid-February highs to the mid to late March lows. The average of them was probably up 10, 15%. If you take an average of those lines there in mid-February. And at the bottom, the average probably fell 25 to 30%. So, 35 to 40% drawdown in these names. And now on average, they're up 10, 15, 20% as a basket. And so these are the things that are working. And these are the things you want to buy on dips. You want to buy the future. You want to buy the kids that are learning how to code AI when they're 8. Those are the kids that are going to be the income earners of the future, not the coal miner's daughter. Pardon me for using that phrase, but you got to think about the future. And I love technology, and I'm wildly bullish. And when we correct again, and my view is that the economic fallout is priced in, we're going to come into all these names big. Problem with these from a dividend perspective is they almost pay no yield. So these are growthy names. They'll show up in our growth portfolio, and I'll buy technology and software and exposure that way, mostly through TDIV, because I got to get a dividend. I can't buy the next generation of internet in the dividend fund because it pays no dividend, right? So that's a bit of a challenge for me on the dividend side of things. When we look at infrastructure, we're going to get an infrastructure bill. We've got to put all these unemployed people, we got to retrain them. It's going to take years. They need to spend a couple of $1 trillion in the US just to fix what's broken. Bridges, but the way to play it is not the traditional infrastructure ETFs. And BMO's got a ZGI, the global benchmark, which we have listed here, is the iShare Global Infrastructure ETF, IGF, similar to the BMO ZGI. That's not what you want to own. What you own in that is a bunch of pipelines and utilities, largely. Those are not going to benefit from steel and base metals that are going to be needed in reconstruction and rebuilding of hospitals and roads and infrastructure, okay, and airports and so forth. So you want to play it through the copper miners, through the base metal miners, and you want to play it through steel. So on a broad basis, the BMO way or the iShare way, or directly into copper, directly into steel. Clean energy infrastructure, if the Democrats take over, the Green New Deal, they're going to unleash tremendous support for infrastructure development and building in the clean energy space. Those are the infrastructure plays of the future, not the infrastructure of the past. So be very, very clear on what to do and when to do it in terms of markets. So let's get into some of the Q&A here. How do structured notes work, specifically on Canadian banks? So a structured note is typically a derivative structure where what they've done is they've taken a long-term call and said, if it goes above this price, you get to participate. And to pay for that, they write some puts and they do a put spread. And so basically, it's a derivative structure that has a defined outcome. And then they've now started to launch these defined outcome ETFs. And when I talk about using a collar or a put spread collar to protect portfolios and some of the stuff that I do, that's a structured defined outcome. You're capping your outside, you're limiting your upside, you're limiting your downside. That's what structured products are and some of these structured notes. You have to understand a little bit about how they're created and ask a lot of questions. But I like them as products because it defines your risk. Typically, though, the way they're structured by the financial institutions, the financial advisors make a bag of money, the issuers make a bag of money, and a client starts off in a bit of a hole and has the potential to make some money. But if you're really bullish on that sector and you like it, I would just buy the sector and take all the upside and not pay all the fees for the structuring. But that's just me. Okay, thanks, George, for that. Frank, Rosie has suggested in his articles and media about this deflationary forces. So that's the output gap, and I had talked about that with Rosie. If you want to see the chat I had with Rosie for 90 minutes, go to my new YouTube channel, and it's there for you. So we talked about that and why we like long bonds. Would there be any bond ETFs you would suggest? And so it's the TLT, it's the long bond ETF, it's the ZTL in the BMO world. But when I say the fixed income market is broken, I'm talking about it being broken from the perspective of a balanced portfolio and what you can expect to get in terms of yield and protection in your fixed income portfolio. And when that inflation comes, when that real inflation comes, bonds are going to be the worst thing you can hold. So for now, in the world where the Fed is buying them all and the US Treasury is still the highest yielding safe debt in the world, we still like it, both Rosie and I. And the longer your interest rate risk, the bigger price performance you have. So Frank, hopefully that clears it up for you. Marvin's asking about collateralized loan obligations. And listen, the stress test that came out today, as the call it the BS test, because they're never going to come out and say the system is at risk, because if that's the case, they're not doing their job. So they're going to give these softish tests, understanding that they'll open the floodgates to liquidity if they need it. And the banks didn't respond well to that, and their Wells Fargo is off, and Wells Fargo apparently has a couple trillion in this crap sitting off book, I'm worried that we do have several $1 trillion of crap sitting there, and if this bear market plays out as I expect over the next year or so, this is where all the crap comes up. This company in Germany that thought they had 2 billion and don't. That's now basically out of business, filed for bankruptcy, I think today. This company was in the DAX 30. Okay, this was not like a fly-by-night Bernie Madoff thing. This was one of the biggest companies in Germany. So, all this stuff in a bear market, you can't hide the crap. You can't. And so, every piece of paper that was written, 12 years ago that went into all these collateralized products that were rated AAA were always going to fail. We know that now concretely with the benefit of hindsight. But these similar products still exist and their credit quality is crap. And if the forbearance and the inability to pay persists, you're going to have massive, massive problems in credit. So yeah, I would be avoiding this like the plague, and I would stay away from anything related to that. If one thinks the Canadian dollar is going down, does one want to be hedged or unhedged? So the idea of being hedged is to not lose money being in a foreign currency. When you're in a Canadian denominated currency, there's no impact. But if you own a foreign currency and the foreign currency is going down, meaning the domestic currency is going up, that's when you want to be hedged. But if the foreign currency is going up, you're going to benefit from that. So if the US dollar is rising relative to the Canadian dollar that's falling, you want to be unhedged. But if your view is that the Canadian dollar is going to do better relative to the foreign currency, whether that's the euro primarily or the US dollar in most cases, then you want to have a hedged exposure. So Doug, I hopefully that clears it up once and for good. I was surprised to learn my largest holding, ZZZD, the tactical dividend ETF that I manage, has a much greater beta than the tactical global growth fund that you manage also. So here's why it's higher, because I have a mandate to get a yield where I don't have the same mandate to get a yield in the growth fund. So I can go to things like technology, like gold, that doesn't pay a yield and sit in it. But to get a yield, I've got to be in dividend paying stocks, because cash yields nothing, and bonds yield very little. And so I'm going to have more exposure, and I do that by way of covered call strategies and so forth. But generally, I'm going to have a higher yield on average, or a higher beta on average. Now, something I couldn't do 3 months ago that I can do today is hedge out the beta risk, which I've done in most of the portfolios. There's still some beta risk in them, but by and large, most of the beta risk has been hedged by a caller put strategy against the S&P 500. So, John, I hope that answers your question. Asking me if you should switch if you require no income, I would say sure. Go do that. And you want to buy the discount class fund unit of the growth fund, which basically has the same MER as ZZZD. I have a significant portion of my portfolio sitting in cash. What are your thoughts on putting some of this into HFR? Bigger question here, Sarah, and came from a lot of people, and we picked yours to answer. HFR is a floating rate ETF actively managed by Horizons. And, should you be in that to generate a bit of a yield? I would say that's okay, but I would much rather be in a ZST, which is a money market based, high quality corporate bond ETF that has a yield a little north of 1%, something like 1.2 right now, and has a maturity of a money market fund, as a better way to clip a coupon in a cash like holding today than any of these high interest savings dividend ETFs. ZST would be better and has less volatility risk than HFR would in a floating rate note. Biggest risk to HFR at this point would be central bank going to a negative interest rate environment, which would have a negative impact, Sarah. So I had a lot of cash. I was waiting for a pullback. It didn't show up. I just put a whole whack of money back into ZST, as I think the next period of volatility is going to be a bit closer to the US elections. So I put some money there. My son has a defined benefit pension plan in his place of work through an investment company. A couple of weeks ago, we were talking about it, and I told him to get conservative. I told my daughter the same thing. The company she works for, she has an option to go in a couple times a year, I think, and change her risk. And I told her before the collapse to pick the most offensive strategy they have, because she does the online KYC and she's in her 20s, and it comes out with maximum growth because that's what it's going to come out with for someone in their 20s. So I imagine your son is probably similar to my daughter, a bit older, a bit younger, but that kind of time frame. And it's no different thinking than what I've said for a long time. If you're concerned, go to the ZCON portfolio and get the conservative portfolio that's more bonds than stocks, more defensive. And when you're ready and the markets have had their sell-off, go to the growth version of it, ZGRO version, and get more equity exposure. And it's that simple. So Alvin, I think it's a good message. And if you want to be active in your retirement portfolio, that's as simple as it can get. Go to the more defensive strategy, go to the more aggressive. But remember, moving to the more aggressive strategy, the most opportune time is going to be when there's blood in the streets, and it's going to feel the worst to do it, but that's the time to take the risk and understand that you're never going to time it perfectly. Michael and Steve are asking about ZPay, and I've said on BNN, for quite a while now, I asked I asked BMO to create this ETF for me. I said, build me an ETF, which is a strategy for picking some of the best companies out there with quality factor and other good momentum earnings companies. And if we don't like the current value, write a put 10 or 15 or 20% or so below the current market, get the yield on it. And the companies we want to own now, own them, get the dividend off those, and write a call to enhance the yield at the level you want to sell it at over the next couple of months. And build a strategy that on average has about 50% long exposure on average, not always, on average, and generate a yield that's going to be 3 times approximately that of the S&P 500. So you've got half the risk on average, not always, on average. When it sells off, you're going to buy good companies cheaper. Thumbs up. When it rallies to higher levels, you're going to sell down. And all the while, you're going to generate a yield. And I love the strategy. And it's going to go up and down with markets, but it's going to do so at about half the rate. Go look at how it's performed through the up and down of the worst financial shock in history, and that'll give you an example. All the while paying you 5.5%, 6% yield. What percentage is a return of capital? So it's going to depend on how much yield they generate from the options writing strategy, how much of a capital gain and sale from the calling away of the ETFs and so forth, or the underlying holdings, is a capital gain part of the return, and to what extent through the growth of the ETF so that all the unit holders are not poorly compensated. So for example, in 1 month, if they have 200 million in the ETF and the next month they have 400 million, but they've earned their annualized 6% that month, but because you now have double the unit holders, they only pay out half the yield. What they will do in that environment is pay out the full yield, but the second part of the yield is a return of capital, so it doesn't disadvantage all the unit holders. And that happens from time to time in a rapidly growing ETF like ZPay is. But that's not a bad return of capital. A bad return of capital is an ETF that says they're going to pay you 6, that only earns 3 or 4 and gives you your own money back all the time to make up the difference, but masks it as a better yield for sales purposes. That's a bad return of capital. Okay, so Steve and Michael, hopefully that answers your questions. Don asked about, do I recall the gold ETF I thought would be good for some gold exposure? GLDI, I believe, in the US, and Horizons has one here, and I keep forgetting the ticker symbol, but go to their website, Don, and you will find it. And is that good? Like, if you're bullish on gold, then just own the gold bullion ETFs, okay? Or the gold stocks if you want some leverage to growth in gold. If you want to own gold but need a yield to live off of, then these gold ETFs that use options for covered call overlay to generate those yields are fine. What are my thoughts on Brookfield infrastructure? So here's a different idea of infrastructure. So Brookfield actually owns buildings and development, and they help build hospitals and green, and Brookfield's a great operator. But for now, the publicly traded infrastructure operators don't know. I've actually gone on many of these private debt and infrastructure conference calls and interviewed many of the managers of these funds, because in our private funds for clients, not in the public BMO funds, but in our private funds for clients, we invest in private debt and private equity managers. And we have like a fund of funds that does this to help diversification. And a lot of these private equity and debt managers are telling us today, we don't know with clarity yet what it's going to look like, but we think this is going to be the way it plays out. But Brookfield is an excellent manager, and I wouldn't worry about them from that perspective, but it's going to be volatile for quite an extended period. Brookfield Infrastructure is different than buying pipelines and stuff, although they own some of that too. Keep that in mind. Would I recommend I divide my portfolio in 1/3 into each of the funds that I manage to allow you to sleep at night? So sure, go for it. I appreciate your trust in me, but you don't need to do that. They're all global funds. They're all managed by the same manager with the same philosophy. And I would say that if you needed the distribution every month because the other two don't pay it, go to that ZZZD. If you want more of a total return strategy, which is how I think of my balance fund, go to the balance fund. I swing dramatically between the safety of fixed income and the traditional equity world back and forth. But if you want long-term growth and you want exposure to my best ideas in technology and not worried about the yield mandate, then go to my growth fund. And if you want a little bit of each, sure, why not? So hopefully that answers your question there, Alo, about what to do. And I can't really advise you on what's appropriate. I don't know how much money you have. I don't know how old you are. I haven't done your financial planning. But you can trust that I'm going to deliver a sleep at night experience as best as I possibly can, but I'm not going to get all the market risk right all the time. So what I'm going to do now is bring up my Bloomberg screen here, as you can see, and I'm going to go to some live Q&A. So hopefully it works for everybody. Hopefully you can now see my Bloomberg screen. And let me go into some of the questions that have been asked online. Question on the Fed and the size of their balance sheet. Rob is asking, and what kind of bubble is going to form if we spend all this money? I think that's the gist of your question there, Rob. So there's not a lot I can pull up on the Bloomberg terminal to help with that analysis. But you know, the more the markets are pumped up because of artificial means, the riskier they get to me. And but that could very well be how it plays out. It really, we could be in this fear of missing out with irrational people buying some of these securities and goosing markets, and it could very well play out that way. So I don't know if that answers your question. You hear to like ZPay, so I talked about that. Is ZUQ currency hedged? So I don't believe it is. There might be a hedged version. I'm not sure. I will ask BMO for some clarity on that. I don't know if Rob is still online listening, but if he is, Rob, please feel free to unmute yourself and comment if there's a currency hedge version of the US quality factor ETF. Actually, you know what? That I can use the Bloomberg terminal for. So I'm going to punch in ZUQ and see what comes up here. And it does not give me a hedged version here. It would show up there if there was a security listed on Bloomberg with a hedge. So I imagine there is no hedge. ZUQ and all the exchanges it trades on, there is no hedge version. So Kamal, hopefully that answers your question. The Canadian dollar has risen. Question is, Canadian dollar has risen versus the euro recently. Do you recommend adding to my European exposure using ZWP instead of ZWE? So if we look at Euro CAD on a currency cross basis, And then let's look at a chart here. And let's bring up a 5-year picture. So over the last 5 years, the Canadian dollar versus the euro has been in a bit of a trading range. And so when the euro is down at these levels, the Canadian dollar buys more euros, so you get better value. And when it's up here, you get worse value, so it's more expensive to buy euros. And so based on where we are now and my expectation for Canada versus euros, I would be buying more euros, kind of when it's weaker down here, than when it's up here, and maybe we're in the middle range and it's kind of neutral. So I'm not a US dollar bear like some are over the next year. It's tradable. I do have some US dollar euro positions on, but I'm playing from a move from 110 to 115 US dollar euro. The Canadian dollar seems to move accordingly, and you got to look at it on an independent basis. So those are some thoughts there. What are my thoughts on the dividend horizons and enhanced income gold producer? So that's the one that the other gold question was asking about. And so I think I've commented, Adolfo, on what I thought about that. And if you're really bullish on gold, then you want to buy gold outright. You don't want to use that yield generating one. Well, gold price is entering a bull market, 2000 on the horizon. I've talked about that on the seminars over the last number of months. Gold is my favorite asset class for the next couple years by far on a total return basis. Gold equities don't yield much, so have much more leverage to the upside. And I think, if I look at what asset class can I make 30 to 50% on over the next few years from these levels, gold is one of the only things that jumps off the page to me, and gold equities in particular. So yeah, that I do like the asset class. Hertz and Robinhood and day traders helping to move market. What is my view on that? And I've talked about that as that Dave Portnoy day trader mentality. And listen, the markets are supported artificially by central bank and government support. The entirety, almost, of the government support to date has been a bridge loan. It's not new stimulus. It's replacing income for a massive amount of people that are no longer working. And all that expires in July unless they extend it, and we'll see how that plays out. Trump, of course, the worse the economy is going into the election, the worse his luck is in terms of getting reelected. So he's got every incentive in the world to get Congress to back an extension, especially if the unemployment rate is so high and we're getting persistent problems with COVID, which seem pretty clear at this point. So these things probably get extended, and the unemployment benefits, and then they checks at home, and the people not actively working, or and hence the Robin Hood effect. But folks, it ends badly when it ends, and it will end. It may not end until we get a vaccine. I've heard that 30, 40, 50% of people are opposed to taking a vaccine. I read a report off of Reuters the other day where they're starting to get now, blood tests from people who had COVID in January and February in the initial waves, and that their immunity 3-4 months later is substantially reduced from what it was. So there's every risk in the world that there is actually no herd immunity from this novel virus that we don't know enough about. And a vaccine is really, does it last a year or two, or is it a good one that lasts like polio, like these, these long-term 10-year boosters that we get because we wanted to eradicate a disease that killed tens of millions of people. This, before it's all done, could kill tens of millions of people, especially if it migrates. There's so many downside risks that aren't priced in today. It's staggering. But hey, if I can make 10% a day trading, go for it, right? Anyways, it's not investing, folks. It's gambling and scalping, and a lot of these Robin Hoodies, I guess, are gamblers and scalpers. And for now, we got to live with it. Claudio asked, can I share my thoughts on what's happening with her? Oh, so same question on Hertz. And, is there a good way to take advantage of the ignorance of these people? And so the short answer is no, because what you learn is the markets can stay irrational far longer than you can remain solvent. So, to lean against the trade, unless you do it in a prudent way, in a risk management way, you end up like these highly profile, visible guys like Bill Ackman and others who put on these massive shorts, come out and pound the fist on how bad Herbalife is and all these things, and then they get smoked. And it's still going, and maybe they're right, maybe they're wrong, but when there's a bankruptcy and a restructuring, unless you're a corporate expert and you understand when the courts are going to rule and how they're going to rule and the whole process and what you're due if they restructure and what's left over, you don't have a hope in hell. And I certainly don't do that work, and I can't advise you on playing that game. So good luck with that if that's something you want to do, but there's far more important things to do and better things you can do than try to play those games. Peter's asking about gold and rationale on gold. Okay, the rationale is this. The liquidity and the disinflation. So the idea of gold as a safe haven is a big part of it. As a deflationary shock, so when interest pays you a negative real return, gold's attractive as a debasement to currency. And in an inflationary world, gold is attractive as a hedge against inflation. Because we find 1% of new gold a year in the mining industry. You can't, like a Bitcoin, you can't create more. You can't create a new robo currency. You can't print a new piece of paper and say it's worth something. Gold is gold is gold, and is the history of monetary exchange and money in the world. And it has these principles that I love. Look at my gold, folks. I get in front of the camera here. You can wear it. You get utility of it. It doesn't rust, and it goes up in value. And you can wear it and use it for a long period of time, however you like, and then you can sell it. So it's a store of value, and it's the original money. And so for those properties, it's very attractive. What I never liked about gold is that there's no yield. So when bonds that pay you a yield or equities that pay you a yield that aren't risky, then gold is wholly unattractive. But when stocks are risky and bonds pay you no yield, gold's tremendously attractive. So there's the story, and if anything, they're never going to get rid of this debt. They can't, and they're going to monetize it, which one day, don't know when, will lead to an inflationary environment. And when that comes, gold is wildly attractive. So Wendy, I hope that answers some of your questions there. what drove jobs overseas was business seeking cheaper labor costs, not the consumer. Respectfully, what drove jobs overseas was business seeking cheaper labor costs, not the consumer. No. It was, but it was driven by the consumer not willing or not wanting to or not being able to pay more. I believe that is the core root. And part of that is the inequality. And it's the fact that real incomes, when I talk about real incomes, Jay, I'm talking about inflation. Jay's left the conversation here. I'm talking about inflation adjusted income and what it was in the 1970s versus it was today for household income, and it actually hasn't gone up. And it's the fact that people can't afford more and more people every day need to go shop at Walmart and need to go shop at the dollar store that is forcing companies to get more productive. And it's the rise in the development of cheaper labor in other places around the world and them using technology to deliver cheaper products that are driving it. So arguably a combination of both. But Jay's left the meeting. Jay, I'd love to have the debate with you. I think it's an important conversation to understand. Thank you for the question. I've taken a position in HIU, which is an inverse of the S&P 500. It's taken a hit in recent weeks. Should I stay in the ETF? Wendy, I'm bearish. I'm as bearish as I've ever been. I think if you stick with it, you'll pay off. There's a 5 or 10% scenario. It goes higher first before it goes lower, but inevitably it's going to go lower. I don't know what your staying power is, Wendy, but I would lean towards that. There will never be options available on ZZZD, Jerry. It's not the type of strategy that would ever have a liquid options market. What happens with U.S. Withholding tax in ZUQ? So they file a W-8 Ben and they qualify for the lower withholding tax compared to an individual that has a much higher withholding tax. So it's 15% versus 30. But the bottom line is ultimately there's a withholding tax. It's a factor. If that's a problem for you, Kamal, then don't use it. But it's the most effective way you can get exposure to good foreign companies that use that factor and screen for the best balance sheets. So we're effectively running up on our deadlines here for 8:30. We got through a tremendous amount of questions. I thank you all for sticking with us. Those of you who have not yet, please go to my new YouTube channel, Larry Berman Official. We'll be posting our weekly updates that will include my best bear pick of the week, my best bull pick of the week, a summary of what's on my mind, kind of like I do at the top of every Berman's Call show on what's moving things and what I think's going on. So a little bit of color for you in between Berman's Call episodes, and sign up for the alerts there and everything. And I think you're going to see a lot of great content there that we're going to deliver. And again, if you want to thank me and our companies, please make use of one of our partner companies. If you're interested in the portfolios that we run for BMO, ZZ, Sleep at Night portfolios, if you want a review of your own portfolio and you qualify as into our custom portfolio, we'd be happy to do that for you. etfcm.com. If you are interested in an independent fee-based financial plan, which everybody should have, check out upotential.com. And if you're a financial advisor out there and want to do better for your clients, check out our Q Wealth platform. Thank you very much, folks. Please support one of our charities, this cancer and leukemia research in particular at Sick Kids Hospital. and dementia and Alzheimer's research at the Baycrest Hospital. And Jared and I match all these donations personally and corporately. Thank you very much. Have a great week, everybody. Remember, for now, Berman's call on Friday, 4:30 until Trudeau gives me my time slot back at 11 o'clock on Monday mornings. Have a great week. Stay safe. Be smart.